Hello and welcome to CMC Markets Weekly Trading Outlook for the week of March the 21st, 2016. My name is Colin Szynski, Chief Market Strategist. This week I'm going to be talking about the ongoing reaction to the Fed meeting, where they took a much more dovish tone than the street had expected. So this week I'm going to talk about how a dovish Fed, and what that could mean for trading in gold, oil, stocks, and forex. So we're looking this week at a short week. It's only a 4-day trading week, with markets around the world closed on Friday for Good Friday. We also have a very light economic and corporate calendar. There's no major earnings announcements. Plus, we have just a small number of economic reports. A couple of the big ones on Thursday. We get UK retail sales, US durable goods. Earlier in the week, we get the flash purchasing managers reports, and that's about it. Even in terms of Canada, we have the federal budget coming out, so that could spark certainly some talk about the economy. Whether how it affects the markets remains to be seen. Budgets usually aren't that big a deal for trading. In the U.S. election, we have primaries this week in Arizona, Idaho, and Utah. So some smaller states this week. So probably less of a focus on the U.S. election this week as well. But we're leaving a week with lots to chew on already, and in fact the last 10 days we've had huge stimulus from the ECB, we've had a rate cut from Norges Bank, we've had a Fed not planning to raise interest rates as many times as people thought, we had stay the course reports from the Bank of England and the Swiss National Bank, so we've certainly got a ton to talk about. Before that we had an RBNZ rate cut, so there's a lot going on. We've seen a number of the central banks that when it seemed that things were going to start going more hawkish, we're back into being a little more dovish again. And in particular, that divergence we'd had between the U.S. and on one side, and the U.S. and the Bank of England on one side, and the Bank of Japan and the ECB on the other side, that's clearly narrowed. We saw it first with the Bank of England going from hawkish to neutral, where they're likely to stay through the Brexit vote. Then we've seen the Bank of Japan and the ECB bringing in stimulus, but there's a question as to whether they'll bring in any more. So they're coming back a little bit. Now we've got the Fed going from talking about 4 rate hikes this year to 2, coming back in again. I actually found the Fed to be surprisingly more dovish than I thought they would be, and where I had taken my cue for being more hawkish was that the inflation was starting to pick up in the U.S. We're seeing signs of core inflation picking up. We're seeing the crude oil price picking up. Back in January, everybody was running around thinking the sky is falling because oil was crashing. Well, oil's not at $26 anymore. It's back at $40. So that can change the dynamic. So we'll continue to monitor the Fed, but that could be an interesting thing going forward, is what happens with inflation. Fed Chair Yellen didn't seem to think that inflation was a concern, and it sounds like the Fed's willing to let inflation run while they keep the economy going. So we'll see what happens with that. That may come back to haunt them later, but later could be a year from now. So for the time being, we have to figure that the Fed's going to be staying reasonably dovish and accommodating for longer than it had seemed even a few weeks ago. And so what has that done? Well, we're seeing the U.S. dollar index starting to roll over. It had gone from 80 to 100 between the fall of 2014 and the fall of 2015. In the last few months, it started to come down. 100's come in as a pretty hard cap on the dollar index, and we saw here it peaked above 98, was drifting down, and then got hit pretty hard on even again, falling down below 95 on the news. So now it's come back about 25% of this 80 to 100 range. Could come back to 90 at some point, but it might have a hard time seeing it going below that, with the U.S. economy remaining relatively strong. Still, what does this mean? What it means is, and the most important thing is, it takes some of the pressure off of U.S. companies. U.S. companies have really been struggling to export. They've really been struggling with their earnings, and a lot of them have been directly blaming the impact of the higher U.S. dollar, the forex effect. With this, some of that pressure coming off can help the U.S. corporate earnings. So we'll take a quick peek here at the Dow and the S&P, and what we'll see is that stocks have actually been picking up on the Fed news. Initially they were quiet, but then they've started to really move up again. And I think the reason that we're seeing that is because people are recognizing the, just like we see with the yen, the higher yen has been seen as a negative for Japanese stocks. The falling US dollar is being seen as a positive for US stocks. It's another round actually of stimulus. Just like a rising dollar is tightening, a falling dollar is stimulative, and that goes for not just the US dollar but for other currencies around the world as well. The one thing we've got to watch for coming into this week though is we've had these nice big strong rallies here, but look at this, the Dow's getting over, US 30 getting overbought on the RSI, and I'm going to show you this again and again and again today, is that a number of currencies are starting to get, markets are starting to get overbought. So this week with a slow news week, we may see a pause, we could see corrections back. I would expect to see moderate corrections, not big crashes, but all the same we could still see some people looking to take a looking to perhaps take some profits off the table ahead of the holidays. So that's the Dow, and if we go now and we look at the S&P, we'll see the same sort of thing. Now, interesting enough, so the S&P has kind of been in a bit of a downtrend here. If we draw the line across these first two peaks, it's still in it. If we come down here and draw this line, it looks like it could be breaking out of this downtrend. So depending on your perspective, it does look like it's trying to break out here. It's already cleared its 200-day moving average near 2015. Also a Fibonacci test has cleared 2040, retested it as support. Those are encouraging signs. Next resistance 2060, and it's near here and around 2050. But look, overbought on the RSI does suggest potential for a pullback at some point. So keep an eye out for that. For that reason, we could see trading choppy in a number of markets this week. Going to move now to crude oil. Crude oil is coming off quite a strong week once again, but even it's starting to encounter some resistance here in and around the $40 level. It actually has peaked above $40 in the early trading today, but look at this, it's now starting to come back down. We need to be careful with this pattern here because this is starting to look like it could be an evening candle, evening star forming. If we get a down candle on Monday, that would be an evening star, which would suggest a near-term top for crude oil. Minor negative divergence, but more importantly, quite overbought on the RSI. Could get a correction here with this failure to hold above 40. First resistance is down here about 38. 20, 30 to 25, let's call it, and then here this is around 36.25. So we could see a bit of a pullback in oil develop as we see this breakout start to fail here, which is a sign of exhaustion. Moving now on to gold. Gold also has been showing some signs of exhaustion lately. We had another spike up in gold here with the when the US dollar started to weaken, but then gold's starting to come back down. So we still see here it's having a really tough time getting above 1270, let alone this 1285 level up here. So and here on the RSI, continuing to trend back towards 50 after being extremely overbought, tells you that it's getting back towards being back towards neutral. So we could see this 1228 to 1280, let's call it 1225 to 1275 trading channel continue to trend sideways, midpoint around here around 1250. But in the short term, with this still coming off, we could see another retest of support here back around 1228, which was where the rally, the Fed rally lifted off from. I'll just show a few currencies here and wrap up for the day. We'll start with dollar CAD. Dollar CAD is an interesting one. It's been really driving down nicely. As we've seen the crude oil improve, US dollar weaken, this thing's come down from 146 down here around this 130 round number. But look, we're getting a hammer candle. We could be seeing a morning star starting to form, so we could be up for a correction in this. And look down here, oversold RSI, positive divergence. This has had a really nice run down, but we're at a point where it could start to go sideways or even tick up a little bit here. We'd be watching for initial resistance around 131.15, then this 132 level here, which was the bottom of a previous short-term trading channel. If it does continue to drop, then the next support's around this 129.15 and then 128.35. We'll also take a look now at cable. and cable continues to pick up. We had seen here, we had the double whammy. The first phase down here was the realization that the Bank of England was not going to raise rates in the first half of 2016, and maybe not at all in 2016. Going hawkish to neutral took it down. Then we had a second leg down on the realization that the Brexit referendum is coming. A date has been set. People are picking sides and starting to campaign. So that caused another level down. But look at this at the low. Big positive divergence here. Said this downtrend was getting exhausted, and now we're seeing it starting to recover nicely. RSI is back above 50 and trending higher. The sterling itself is trending higher, sitting around 145, just below it. Support rising to 144. Next resistance 145.85, and then that's around 146.80. I'll do the euro dollar and the dollar yen. Euro dollar here has run into a little bit of resistance. It's come back up here at just above 113, running into a wall of resistance here. Slightly lower high on the RSI tells me this upward momentum may be starting to fade, and maybe we're going to go back into this big broad new sideways trading channel here. First support just above 112, then this is 111.11, and these cluster of moving averages around 110.40, 35 to 40-ish here. So we could see a bit of a pullback if we do start to see and what could drive all of this would be a bit of a bounce in the US dollar having been knocked down earlier in the week, and that would just be probably a lot of squaring of short-term trading positions in the coming days. But if the Fed remains neutral, then we could still see the dollar come down more over time. So I'm just going to finish here with dollar yen. And basically we can see here, look, dollar yen peaked under this 110, 111 even level, which is a Fibonacci level. And look at this, 1, 2, triple bottom now in place, hammer candle. It looks as though this down and positive RSI divergence as well, higher lows, decreasing downward pressure and potentially momentum to upturn pending. So, but look at this, it's run into a pretty good floor here. It keeps hammering, trying to hammer out a base here, hammer there, hammer here, and so what could we see on a pop? This first resistance about 111.60, and then here around 112.65, and then this one up here around 113.85. It's about a 114.50 down to 111 trading range here. But again, it looks as though the weakness in the US dollar might be nearing a limit for the short term, at least for the coming few days. And some of the currencies that have been knocked down are starting to bounce back, and some of the currencies that have been rallying might come back a little bit in a correction. So with a light news flow, we could see a choppy week for trading. We have a number of markets have been getting overbought, overextended, oversold, and overdue for a bit of a trading correction here. So it's possible we may see that this week, especially as we head into the holiday weekend.